Now, the Fed has officially pivoted. And yesterday, the Fed decided to leave rates unchanged, and they are now forecasting 3 cuts for 2024. This is huge news because the Fed has been very cautious in saying that rate hikes are not over yet until inflation recedes further. So let's go ahead and talk a little bit more about some of the things that Jay Powell said in yesterday's Fed meeting. And first and foremost, let's go ahead and acknowledge that he said that inflation has eased from its highs without causing a significant increase in the unemployment rate. Now, this is technically true because we are seeing evidence through economic data that has been released lately. For instance, this week's CPI report showed that inflation slowed to a 3.1% annual rate in November, mainly due to a large decrease in energy prices, while core CPI increased by 0.3% on the month, which was right in line with expectations. Powell also said that they've decided to leave interest rates unchanged and continue to reduce their securities holdings. So far this year, the Fed has trimmed their security holdings by more than $1 trillion. So these are things like mortgage-backed securities, treasury notes, and really this is one of the main reasons why mortgage rates were so low for the decade of 2010, and then obviously after the pandemic, because the Fed was buying upwards of $40 billion a month in mortgage-backed securities to keep those rates low. And then they stepped it up to about $80 billion a month or $100 billion a month during the pandemic, which is really the reason why rates went down to 2%, 3%, et cetera, until they started to climb up, right? So Powell also said that their policies have indeed put downward pressure on the economic activity and inflation, but the full effects on their tightening likely has not been yet felt. So the thought process here is, as they leave rates unchanged for a little bit longer, it'll give some more time for the economy to kind of catch up and start feeling some of these restrictions without sending the economy into full recession mode. Although the Fed committee has revised assessment of GDP growth, with the median projection falling to about 1.4% next year. So honestly, what this may mean for Americans is that things might not get any better, at least something that you can see, right? I mean, grocery prices might not fall just yet. More unemployment can come. The economy has not caught up to the fact that the Fed has increased these rates by so much. So let's see what happens over the next few months. I think, there's going to be a lot of data coming out, and it's going to be coming out pretty weak. At least that is sort of what the Fed is hoping for, which is now at that point, they're going to address what they're going to do with rates moving forward, right? Let's go ahead and move on. So he also addressed that the labor market remains tight, but supply and demand conditions continue to come into better balance. This is evidenced by the payroll numbers. So job gains averaged at about 204,000 jobs per month, which is still a strong pace, but it is well below than what it was earlier in the year. In fact, November's job report showed that the economy added 199,000 jobs, which is well below the monthly average of the last 12 months, which is 240,000 jobs. Lastly, Powell indicated that if their projections are correct, the Fed's expectations that the appropriate level of the Fed funds rates will be at about 4.6% at the end of 2024. So this is roughly about 0.25% decrease every single time of the next 3 times. Obviously, that's kind of what they came with that number. 3.6% at the end of 2025 and 2.9% at the end of 2026. So overall, his speech was very positive because literally we have not heard any indications until yesterday that the Fed was considering slashing interest rates and keeping the federal funds rate at the current target of 5.25% to 5.5%. Which is where it stands at right now. The market obviously took a liking to his conference call, to the conference, not the conference call, with the Dow closing at an all-time high of about 37,000 points, while both the S&P and the NASDAQ reached a high for the year. The Russell 2000 index also increased by 3.5%. And right now, as I'm making this video, day after, the Dow is up 37,147 points, so it's up 0.16%. The S&P is also up. The Nasdaq is basically just flat today. The Russell 2000 is also up by another 2.5%, And mortgage rates also definitely took a liking to the news because yesterday they dropped like a hammer to the lowest level since May 2023, with the average 30-year conventional interest rate down to about 6.82% nationally. And I am pretty sure that today rates have also decreased a little bit further. So, just great news overall. I'm going to keep you guys updated with what's going to continue with interest rates and what may happen moving on forward. We do have several economic data coming out this week, such as retail sales, which is a really good indicator of the health of the consumer. We have building permits and housing starts, both coming out on December 19th. Jobless claims on the 21st, and very important core PCE and new home sales on the 22nd. So definitely the year is still not over. There's still a lot of data coming out. And if, these readings are weaker or even in line with expectations, we can expect that the Fed will be cutting rates sooner than expected. Well, thank you guys so much for watching the video. I definitely appreciate it. Hopefully this helps you out understand a little bit more of what's going on. And I hope you have a very nice day.